In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
$16-year high. It's about a 16-year high-ish.
Hey, welcome back to all of our market rebels and our YouTubers out there in options land. It's great to be back. This is Coach's Corner. We do it every Thursday at 4 p.m. And Stu,
Yes.
turn around Thursday a little bit. I was counting on 7 straight green candles. I was all hopeful for that for our announcement here on Coach's Corner. But something happened in the afternoon. What went down?
I think it had something to do with the long bond rate auction.
Long bond rate got smoked. Yep.
Yields were coming in high, and right around 1 o'clock when those auction results came out, the markets got smoked. They did recover
A little bit.
somewhat after that, but yeah, the rates are running the world.
Yep. So I think it was 4 1/8, kind of the coupon rate, and I think it was like 4.837 if I remember correctly. It was anyway quite a bit hotter than what they thought. So again, more excitement for the markets, more reason to hedge your bets, and that's what options are all about. So today, Stu, another good question. It's one that you and I get a lot in Q&A, and I thought it might be helpful to share with our viewers out there. So let's start off with a little question, as we always do. For anybody who's new, we start off with Chalk Talk. It's our little kind of a thought question, something to think about briefly, jot down your answer. We'll come back and revisit it at the end. But here's the setup. You bought 100 shares, $100 a share, and you sold a 105 call for $3. Question is, did you generate income? That's what most.
It's kind of a funny question. When I see that term, I picture some machine in my head, like on the side of the road, just spitting out $100.
Generating income. That's kind of where we're going. You've got the thought that I think we're on the same wavelength here. So today's topic, income generation, fact or fiction.
Yeah.
And the reason we want to bring this up is that a lot of traders just grossly misunderstand when other traders say, oh, you can use this strategy to generate income. Sure, you could look at it that way, but they are missing a very big piece of the puzzle. And if you're not taking that into account, it could lead to disastrous results. So that's what we want to talk about today. And this whole idea of income generation, there's a lot of ways to do it, but normally among options traders, Stu, it's usually somebody selling an option, right? Like in the example here that they sold a call, covered call, or they sell a naked put and say, oh, I don't mind getting assigned, or they sell a vertical spread, trying to create credits. And it's the idea of these credits that is generating income.
Yeah. People say it all the time. I'm going to sell some call because I want to generate
some income.
They have this idea that, I'm going to sell this call and I'm going to take my annual return from 12% to 18% just by selling this call.
Right.
Well, go ahead.
That's what we want to investigate and kind of explore here, is to show there's another side to the story. That's one of the things we try to do here on Coach's Corner. Show you a little bit more of a professional
viewpoint and some things to consider. So let's start off with the definitions to income generation. Let me ask you, you can kind of answer for our audience here. What do you think of when you hear the term income generation? I know you said a machine on the side of the road, but
I think of a Generac on the side of the building, just pushing out $100 bills. That's what like. How am I going to generate? Well, if I do X, then all of a sudden I'm going to make money appear.
Exactly.
That's what I think of.
Yep, and I agree. This is my answer. There's usually some notion of consistent monthly income. And I've highlighted the word consistent because that's where I think a lot of traders break down. Could you say that you've created a credit because you sold that call for 3? Sure. But when you really hear the phrase income generation, it's usually meant, for most people, would be kind of this passive idea. I'm just going to put this money aside. I'm not going to do anything. I don't have to worry about it because it's risk-free. And I'm just going to get this monthly check over and over and over. But there's not really any sense of risk. We talk about it a lot with rental properties. Maybe you've got a rental property sitting here vacant. So all of the expenses are covered. It doesn't really cost you anything to put somebody in there. All of those expenses had to be covered anyway. And so if you put somebody in it, you can say, all right, now I've got this consistent, whatever, $2,000 a month coming in. I could buy that argument for saying it's a way to generate income. But the thing that we're going to question here is this idea of it being passive, like you say, just auto-generated, and is it really risk-free?
I could also make a counter argument to that as well. That whole rental income thing, which may be true. It may be true, but here's another angle to that. Suppose you're in an environment where rental rates, and I know it doesn't happen like very quickly, but it could happen over periods of time. What happens if you are in a time space where rents are rising? You rent your apartment out for
2 years
a month.
Right.
Well, maybe you signed a 2-year lease at you gave the tenant a 2-year lease. Maybe you gave them a 3-year lease or a 4-year lease. And what happens 6 months from now when that same piece of property, similar to it, is now
25% higher, right?
$2,500 a month,
right?
Or maybe 2 years from now, $3,000,
right?
So, are you still making money on it? Yeah, you still have the money flowing in, but did you give up the difference? Yeah, you gave up the difference.
There's an opportunity cost in there, sure.
Yeah.
Yep. So the thing that I think traders should think about when they hear this phrase income generation, what you're really doing is you are putting money at risk to generate profits. And that isn't really generating income. Because for that matter, you could say, oh, I bought 100 shares of Microsoft, I'm generating income. Well, maybe if they go up by the end of the month and you can sell it. But what you really did is you invested money. And there's a very big difference. Again, what we're trying to point out here between an investment, putting money at risk in hopes of getting more, versus this idea of passive income from just writing options.
But it's much different. Bill and you were talking about this earlier today. Look, how about like me? I bought a T-bill this week. Am I generating income? I paid for it. It's a debit. They debited my account. I bought the T-bill. But am I generating profit with that? Well, my answer to that is actually yes. Because I know that I'm going to, at the end of the period of the T-bill, which is a 4-week bill, I know I'm going to get more than what I paid for it.
Correct.
Did I generate income risk-free? Well, yes. Because I have full faith in the idea that the government's going to pay me. I did.
Yep. And that's kind of what I got.
The value of that money has a value today and it has a value of the money later. And the difference is the yield.
Yep.
When you sell an option for, and that's consistent, right? And I could do that every 4 weeks. I could do it every 1 year. I could every 2 years, 10 years, 7 years, 20 years, 30. Does this sound familiar? These are all the terms of the bills and the bonds. I could also say, well, if I sold a call to generate income, well, will I generate income? I don't know. That call has a value. What's the future value of that? Right. I have no idea. I have no idea what the future value of that call is going to be. If I sell it at $3, did I generate $3? Well, Not if you have to buy it back at 5.
Right.
If you
if you covered it, what's the underlying asset? What's the underlying stock going to be? You might have made money on the call, but it's more this idea of putting money at risk. So the first thing, the first thing that we want people to understand is this idea of consistency. When people talk about generating income, there should be some level of consistency. Every 4 weeks, I can buy a T-bill, or I put it in a CD that's going to pay, or an annuity. I'm not saying that they're great deals, but I'm just saying that somebody buys an annuity and they get this every single month coming through guaranteed. Yes, I would buy that argument to say that it's income generation. But now let's take a look at what happens when people think that they're generating income. And before we do, as always, please check out marketrebellion.com /get started. For anybody who's new, we've got a lot of great videos, information, classes on there, absolutely free, can help you to get started with your options trading. So let's take a look at one of these strategies here, Stu. The covered call, we hear this one a lot.
Classic income generation.
Classic income generation.
Income generating strategy.
Right.
Classic.
Yep. And I do understand, again, when people say that, but what we want to show is why you have to be careful with this before you say, let me just start buying whatever stocks and start selling calls because I can generate income. Now, the other thing about the covered call, it's ironically usually the entry-level strategy for a lot of stock traders, because you have to have the shares in the account. They've got the shares, they've had the shares, they're totally willing to hold that downside risk. But it's now a short option. And so it's kind of weird synthetically. It's the same thing as a naked put, which your broker will require the highest level of option approval for a naked put, but they require the lowest for the covered call, and yet they generate exactly the same risk graph.
Exactly the same risk graph.
Yep. Exactly. So let's take a look at it. Let's say you bought 100 shares, or maybe you've had them in the account for the last 10 years, doesn't matter, but you got the shares in there, and you sell 105 call for 3. All right. Does this generate income? That's a question, because that's what most people see, that I sold this call and I generated income. And here's the point that they miss. As soon as you do that, this is your risk graph, right? If we had the straight line before the shares of stock, but when we sell the call, we put this little bend up here at the strike right there at 105.
It's an obligation to deliver.
An obligation to sell. We're not going to own those shares above 105 at expiration. So there's our maximum gain.
$3.
It's $3, but take a look at this tail over here. You've got unlimited downside risk. Okay, minus the $3. But the point is that they forget about this. See, this is very different from buying a T-bill. You don't have this, Stu, on your T-bill.
No,
you've just got this.
Right.
You're just all green no matter what happens.
Right.
You're all green.
Now, look, I'm going to throw this back and I'm going to say, well, if I'm going to own the shares anyway, no matter what,
right,
I'm still going to have that downside slope.
That's correct.
So if I go ahead and I sell the call, didn't I then generate, stupid term, man, I'm telling you, it's just a marketing that word. Didn't I then generate $3?
And again, a good argument. You could say I've got money in my pocket that I wouldn't have had I not sold that call. But here's the counter argument to that counter argument. You could have sold the stock. You could have put that $100 in cash, maybe stuck it in a T-bill. But instead you said, you know what? Let me hold it for another month while I'm short this call. So even though you might not explicitly say that, that's really the decision. It's always a marginal decision, day by day, month by month. Doesn't matter if you've been holding it for 5 years.
Yeah.
Are you willing to hold it for another, let's call it 30 days, if this is a 30-day option?
Whatever the
term is. And if the answer is yes, well, now what you're saying is I'm willing to assume this risk for another 30 days so I can grab this $3. But what traders forget is that this never goes away.
See, I think it's kind of, I think you have to look at it. I think you have to look at the package and then break it apart and then put it back together. So you have to say, all right, if I'm willing to hold the shares anyway, and I'm going to sell this call for $3, then what? Okay, if the stock goes down, I'm going to get buried. If I get the $3 and the $3 goes to zero, That's worthless. If it goes to zero, did I generate $3? Well, yeah, I guess you did generate $3, except you lost 10 on the stock. So as an overall package, did you lose or did you win? Well, you lost because you lost $7, right? You lost 10 minus the 3, which is 7. However, the $3 went, it didn't go from 3 to 0 because you sold it. It went from 3 to 0 because it became a worthless option over time, over volatility, over the stock price movement. But the $3 has a value.
Mm-hmm.
The value at the time that you sell it, it's $3. It's not $3.10. It's not $2.90. It's $3. And that value may become something else. It may become 0 and it may become 5 or 6. So the other side to that, to what I just said, is that $3 may actually become 6. Did I generate income? Well, yeah, you still generated the $3.
You still got the $3, but in the end, it cost you
$3 of extrinsic goes to 0, no matter what. So I could really, I could debate that on either side. So it goes back to what Bill said in the beginning. It's just the wording.
Yeah,
it doesn't mean a thing. It's just how are you going to create an accounting entry? Let's talk turkey when it's all said and done and see what actually happened. And then we'll decide, can we say we made money on the package?
Yeah. And those are all good points. And this also is why we're talking about this. It's not a clear-cut answer. It's just that people overlook this aspect of it. So you brought up a good point. If you sold it for 3, you got to buy it back for 6, or maybe let's say the stock went down. We keep all of the $3. We are better off. But does it really kind of fly in the face of this idea of income generation? Usually when we're doing that, we're talking about our pile of cash is getting bigger. I got a certain amount in my checking account, and after my income generation strategy, just like you were talking about with your T-bill, I'll have more. That's the thought process that people have, and they think that's what's happening with this strategy, which is why you've got to be very careful of the stocks that you're picking for that strategy.
Yeah.
So just remember,
and it's not overrun by the lack of expiration date on the stock. Right. The stock does not have an expiration date. So you might say, you might kind of talk yourself into it and make it okay in your head, because you could say, well, the stock, I can hold the stock in perpetuity. And, when it comes back, it comes back. I don't care if it takes 10 years. Well, number one, there's a cost to that.
We're going to talk about that. Yep. Good points.
Right. And also an option, even though it might be, it might be a term, my option has an expiration. Look, that doesn't mean you can't renew it if you're using some sort of a stock replacement option as well. Like options can never, we've said this before, option expirations can never run the idea. They're just tweaks as to, cash flow, cash outlay, price per unit, that kind of stuff.
Yep. So with a covered call, number one point to remember, people, you are holding all of the downside risk. Don't forget that. That's the deal. In exchange for, in this example, for the $3. Now, when you do this, one of two things will likely happen. Because if you really want to make the argument that this is going to be income generation, again, our pile of cash is getting bigger, this $100 stock should stay at 100, at least on average, month after month. Might fluctuate a little bit up or a little bit down, but overall, it's just staying there, or maybe slightly trending higher.
Right. But that's a great illustration. Think of like the future, right? Your $100 stock. If somehow you knew that the $100 stock was going to be $100, and you were able to sell some call over and over and over and over again, could you kind of say maybe I'm Yeah, I guess
I would completely reverse my opinion.
Which is where the whole utility sector kind of, until recently fell into.
Yep.
It was more of an interest rate thing.
Sure.
Owning utilities with the dividends, it lent itself to the idea of generating money because of the high utilities. The high dividends that come back through owning the utility. It's a similar idea, but the bottom line is you don't know what the stock is going to be. And if we knew the stock was going to be 100 forever, without any volatility at all, then the
Options
option
would be zero.
would actually be zero,
Yeah.
and you wouldn't be able to sell it.
Right. Right. Exactly. So here's the thing that is most likely going to happen. So let's say that here we go. There's our $100 stock. There's our $100 line on our chart. Here's one path. This is Murphy's Law path. The day that you bought that stock or that you decided to sell that call, that you do this. Now, it's trading at 80 and you have a big pile of losses. Now, this could be months or years, which you kind of alluded to earlier. And so now you have to say, did I really generate income? Well, again, yes, maybe every month I'm collecting a couple of bucks or $3 on it, but overall my cash pile is shrinking. But here's an even bigger point. If you sell that $100 call up here for $3, down here at 80, you're not going to get anything for it. So what do we have to do now, Stu? We sell the 80 call or maybe the 85. And if we're going to get hit by Murphy's Law, what's going to happen then?
Well, you know what's going to happen, right?
Of
You're
course.
Now
Now
it's, and you're going to lock yourself into a loss because now you have an obligation to sell stock at 85, which you then got paid $3 for. And then that's, read between those lines, people. That's an assumption of volatility is the same. So if you're now getting $3 for the 85, which means that you have that obligation at 85, of which you're getting paid $3 for. Same thing as the 100. Same thing as the 105. You're getting paid for. You're just recentering the price. Now you have an effective sale price of 88, 85 plus 3. And you have a purchase price of 100 on the stock, right? So you're paying 100, you're selling it at 88. How's that working out for you?
How big did your cash pile get then?
Yeah.
See, so either A, if we go into this downtrend, you're either not really able to sell calls. So again, this could be months or years. You're going, hey, the stock really just tanked. Here it is at 90. I don't want to sell a call because I'm afraid of this. Now it's at 85 and then it's at 80. And pretty soon we're going, I can't sell it. Or if you do, this now becomes a huge risk. And now you're spending cash. You sold that call at 3 and you got to buy it back at 5. And that is far from income generation. It's just it's the opposite.
Why is the option trading at 5? You gotta really have these conversations. If I sold them at 3, right? That's in the past. Forget it. All right, you sold them at 3. So what? Why is it now trading at 5? Right, there's got to be a reason. It's either implied volatility is through the roof, or which is more likely. The second one is because the stock is up.
Yeah, stock options in the money now
precipitously. Yeah, it's up, right? Because at expiration on that option, in order for that option that you sold at 3, which was the 105, to be 5, the stock has to be 110, which means the stock went from 100 to 110, which means you made $10 on the stock and you wound up losing. You sold them at 3 and now you got to pay, where would they be? 7.
Yeah.
No, you got to pay 10, right? So you lost 7, but you made 10 and lost 7, which is the $3 that you sold. Did you generate any money? I don't know, man. That conversation could go back and forth all day long.
Right. That's the point that we want people to understand. Because we hear so many people say, oh, I just want to start doing covered calls. I have no idea what this stock does. And the reason I'm doing it is because I want to generate income. Well, you're really just putting money at risk. It's just a strategy. So now here's the second. We said there were one of two things that are most likely going to happen, right? The stock just hovering around this flat black line is probably not going to happen. So you're either A, going to head down into the depths down here into Davy Jones's locker, in which case there's a lot of problems here. Or what else happens? Now we get to where the stock ramps up through the roof. And again, for the reasons you just talked about, Stu, we have to buy these calls back at losses. We sold them for 3, buy them back at 5. Sell them for 3, buy them back at 7. Well, again,
my math was off a little bit on that, everyone. I'm sure most of you guys caught me on that, right? So that 105 call is now with the stock trading at 10, 5. Right, 5.
It's a 105 call, right?
3, and now it's 5. So you're losing 2 on the option, but you made 100 to 110. You made 10 on the stock, right? So you made 10 on the stock. You lost 2 in the option, and you walk away with $8 in your pocket, and you're a happy camper. You are actually check this out, Bill. You're actually happy that you lost
on the option
$2
all day long, right? But here's the problem, though. If you get into this. Yes, you are on a net basis better off by the option premium. So you could do this all day. Sell the call at 3, buy it back at 5. Sell it at 3, buy it back at 8, assuming that's intrinsic value. and you will always be better off just by the premium. However, here's the big however, Stu. As we're spending this cash, as the stock is on this wild tear, let's say it's now trading at 210, but our cost basis is now 200. See, that's another point that people fail to recognize. They think, oh yeah, I paid $100 for it. Yeah, but you've got a lot of debits now to try to keep those shares in the account. Now what's going to happen? Murphy's Law strikes, and now you got to pay the piper, because now you've got a cost basis of 200 with the stock at an all-time high.
Yeah.
Where's your income? Your cash pile is shrinking. See, that's the big problem. So again, as you can tell, we can debate this back and forth whether you're generating income, and that's not really the issue. The issue is to be aware of the way that options work.
Right.
And why you have to be
to know where you are, to know what the values currently are, what the values will be down the road.
Yep.
And this part's up to you. Make up 10 different scenarios. What if the stock is here? What if the stock is there? What if? On and on and on and on. What will my position look like? And don't worry about the semantics of, did I generate income, or did I do this or did that? Am I making money, and is it making my goals? That's it. That's it. Just keep it simple.
Big one. Yep. So again, quick reminder for everyone, marketrebellion.com/get started. All kinds of, I was just on there the other day, so there really are some very cool videos and tutorials and articles, lots of great stuff. So please go out there and check it out. You want to make sure you're getting good information. I can assure you, you got to be careful about YouTube and other sources on the internet. Lots of really bad information out there about options. So good starting point for you.
Here's an interesting take on this. So you said earlier, correctly, that buying the stock and selling the call risk-wise is the same thing as selling the put. And it is. It's the synthetic put. We talk about that a lot, synthetics. So if I sell the put, let's just substitute the covered call or the buy right for the sale of the put. Let's just go out and sell the put.
Sell the put.
All right. Now that sale, that $3 sale goes to zero. Right. The value of the $3 put now goes to zero.
Mm-hmm.
Did I generate income? See, it's really interesting. Did I generate income?
It is.
It kind of looks like, how can you say I didn't?
I picked up $300 for doing nothing.
For doing nothing, right? But you got to weigh it against what
the fact is you had risk. Right. What was the risk that you took? You still had to post a hefty margin requirement, usually about 20% for an index, 25% for a stock. You still have to put money at risk. And even with that issue aside, because that's more of a man-made rule, we could just say, for a thought experiment, just forget about the margin. You still have the unlimited downside. The difference between the naked put and the covered call is when you buy the shares. Yeah. If I do the covered call and you do the naked put, I buy the stock now and sell the call, and you sell the put. What happens if the stock goes up? I don't have my shares. You don't have shares. We both just collected the premium. If the stock goes down, I have shares plus the premium. You get assigned. You have shares plus the premium. They come out exactly. It's just a question of when the stock was purchased. Now, here's a good question, Stu. Wouldn't I be better off by selling the call, because the call sells for a higher price than the put? You hear that one a lot too. What's going on there?
Well, I think we have something called, which everybody is familiar with these days, cost of carry.
Cost of carry. I had to buy the stock up front. Right. And so I had to pull that money out of the money market. And so you get compensated for that. So
we have the value of money.
No freebies.
Forget that, people. Money has a value. And the higher the rates go, the more valuable in the future that money is worth.
Yep.
That money that you're not using, I should say, to buy the stock, that money now gets pushed into the premium of the call. So you're not getting the call for free. You're not getting any extra money just because right. It's part of the pricing mechanism of the value of the money.
And exactly what we're trying to get people to see. There's a lot of moving parts in here. Just be very careful before you say, oh, I just retired and I've got this big portfolio. Let me generate some income by selling these options. It's a fine strategy. I have nothing against it. I do it all the time. But I'm aware of what I'm getting into. I realize it's more the perspective of I'm putting money at risk in exchange for trying to get a reward. It is not really, in the truest of senses, to generate income. Let's take a look at.
I'd be okay if somebody said to me, "Yeah, I got this stock. It's $100, and I went and I sold this call for $3, and I bought them back at 50 cents." And they did that 3 times in a row, right? Made $1.50 3 times in a row, and it's all said and done, and it's over, and everything's covered. Sorry, and the stock is still the same price. And they said to me, "Yeah, and I generated some income." I could kind of live with that. I could live with that. It's iffy, but I could live with that.
But you could also make the argument, I just bought 10,000 shares of Microsoft on margin, and it went up a little bit, and I sold them, and I've got money that I didn't have. That's kind of what we're saying here is that, yeah, maybe you got lucky. Maybe you sold those calls 3 times. Don't forget that you were taking the full downside risk. That's the point.
Yeah.
So here's the other side to it, kind of what we've been talking about here. Really, any investment could be seen as income generating. Like I just said, what if you buy shares of stock and you sell them at a profit? Is it really fair that you were doing an income generating strategy, or did you just invest in shares and got lucky?
I think it's fair to say that
is an investment.
Any strategy that unless you're setting out to lose money, any strategy that you do is an income generating strategy.
Correct. That's the whole point. You could make that
there to lose money. I mean, I don't think you're there to lose money unless you got some ulterior motive going on, and I'm not even going to go there. If you're looking to make money, and any strategy that you pick, you really could say, "Hey, is that an income generating strategy?" Right? I mean, you wouldn't be doing. But you got to take into you got to think about the other side of it, the risk side of it.
Here's a vertical spread. Could I say I bought the 100 call for a certain amount and sold the 105? So or maybe I bought a 6-month $100 call. I'm going to sell these weeklies and generate income. Well, you could say it, but it's just a strategy. It's putting money at risk in exchange for a potential, keyword potential reward. And because it's a potential reward, that's where I draw the line of saying it's not really income generating. So back to the covered call. Well, all of these may generate gains, but they may generate losses.
And I guarantee you, I did not know that red line was coming.
It's kind of an obvious, right? We know that's the other side of the trade.
But we think about but Bill and I are thinking about this in the right way. So we come up with the same conclusions.
Yep. So let's do one more. How about a diagonal spread? I just kind of talked about that. Maybe you buy a 120-day $100 call, you spend $20 on it, and you sell the 30-day 105 calls. You're doing this over and over for $1.50. Well, your first shot, you're in for a net debit of $18.50. Are you generating income? Well, again, it's the way that I would see it. It's more putting money at risk. It's more of a speculative investment. You've reduced the downside losses on a speculative position. That's really the way to see it. So here's the risk graph of that's a real risk graph, by the way. It's not made up. That's what it looks like. So if let's say you sell this thing 4 times at $1.50 each, okay, you collected $6 and $6 on your 1850. I know it's going to be a little iffy right there because of time decay, but roughly $6 on 1850, 32%. And you say, wow, I'm generating income. Yeah, but the entire time you were doing this, you had, or at least on the first round, you had this for a loss. And we could also say, well, what if you collected 6? Do you have 1250 into it now? Well, not if the long position is now worth even more. Remember, that's always the current market price is really the amount that you're risking. Doesn't really matter how much you spent for it. But these are some of the things that we find that people make the mistakes. They look at that little sliver up there and say, I'm generating income, and they forget that it's just an investment. And I think that's really the big issue. Any final thoughts on our friend, the diagonal spread here, Stu? We know I do a lot of them. It's a fabulous strategy. I just am a little shaky when people call it income generation.
Yeah, sometimes people get carried away with this whole cost basis thing. It is an accounting entry. It is a way to look at it.
Yep.
However, you have to think about, well, like you were saying with this call, well, where is it now? It doesn't really, it doesn't. Here's an example. Let's just use stock, right? I own Apple. I don't own Apple. I own Apple calls, but I don't own Apple. All right. So now let's just say I did own Apple. If I own Apple at, I bought it when I was in my 20s, right? I bought it when it was $25. And now it's $180. I think it's about $180. How much is it now, Apple? I haven't looked at it today. How much is it? $180. There you go. Right. So now
right on.
And it's split umpteen times, right? So
right.
So what's my cost basis?
Pennies.
Is it 5? I don't know. Maybe my cost basis is 5. Well, does that mean it's going to be okay if I let it go from 180 to 5 and lose 100? No. People make themselves feel better. It's so stupid. Right. I don't care what your cost basis is. As far as I'm concerned, it's 180.
Oh, that's the way a trader would see it. I've talked about this in Q&A. Both of us have in Q&As, and said it doesn't even matter if you found it or if your rich uncle left it to you. You shouldn't say, "Oh, it has no value." I inherited $10 million worth of stock. You know what? It went to zero, but hey, no problem. Didn't cost me anything. Would you really see it that way? I doubt it. So there is a difference between, are you trying to grow your principal? And yeah, in cases like that, we might want to separate it out. But from a risk standpoint, we always have to say it is the current market price. So back to our covered call, as that stock is going up and you're buying these things back at losses, actually the total risk is increasing. So it really becomes a double whammy, because now that downside has become much larger.
So Bill, I was walking down the street the other day and I found a $20 bill. Now I want you to ask me, what was the cost basis of my $20 bill? Guide asked me.
What's the cost basis on your $20 bill?
Well, it's either 0 or 20. How do you want to talk about it? Look, the $20 bill, even though I didn't pay for it, and even though somebody gave it to me or I found it,
doesn't mean it doesn't have value.
Cost basis is $20 because
it's worth $20.
I could spend that $20. I could buy $20 worth of goods and services with that $20. So to me, it's worth $20. What's the difference where it came from?
Correct. Yeah, that's a whole behavioral finance thing we've talked about. People get their income tax returns. They go, "Oh, look at this free money I got." No, that's your money.
Stupidest thing I ever heard.
Oh, yeah, we hear that. So
not that I ever heard, but it's up there. It's so dumb.
So we hope that this gave you some interesting insights, because we hear this from a lot of our traders. Again, we just want to make it real clear. We are not against a covered call. I use them all the time. I just want to make sure that people are aware that when they talk about income generation, usually from retirees, I want to buy an annuity, so I have this consistent $5,000 a month coming in. That's not what's going on here, even though people say it's an income generating strategy. It's more about
I'm not against getting an income tax refund check. Don't get me wrong. Look, money is money. What I am against is you not realizing, or the taxpayer not realizing, that they are lending money to the government for free.
For free.
For some period of time. And if you want to sign up and get in line to, make loans to the government for free, then go for it. Right. I'd rather see you adjust your W-4 so you don't take out as much money every week or month, however you're getting paid, so you don't get that income tax refund, and have the financial discipline to bank the money so you have the same amount of money at the end while you earned interest on it all that time. And, maybe have a savings account. Oh, there's a novel idea.
Nothing that Americans are too familiar with these days. So anyway, let's close up here with our chalk talk. So you bought 100 shares, $100 a share, $10,000 outlay. You sell this 105 call for 3. Did you generate income? So Stu, after this whole debate, what's your answer? What would you say?
No, you did not generate income. I'm going to just say no.
Yeah, I would say... I would say this is far more putting money at risk. I would put it more of just a strategy. It was an investment, and investments can go down, they can go up, but that's not really what people think about when they hear generating income. And I think that's really the dividing line. What do you mean when you say generating income?
Yeah, you have to make the distinction. Did you make money on the strategy? You may very well have made money on the strategy.
Sure you did. Yep, you made $3.
And it worked out for you. Did the sale of the call in and of itself, listen, we know that $3 is going to zero. We know that.
Right.
But we don't know if there's going to be any intrinsic value, in which case that option might be a $5 one. Then did the strategy generate income? Well, the strategy generated income,
but overall you lost.
For you. Right. But the option lost for you. So look at it as a package. Always look at it as
always a package. Yeah.
A lot of people do that. They say, well, I bought this and I sold this. I did this spread, but I'm getting killed on the sell side. Really? Well, what about the other side?
It's a package, right?
People say, I can't roll. I don't want to roll. It's going to be a debit to roll this option. Really? Why is it a debit? Well, because the long side of it is now, $15 instead of $8, right? You just made $7 and you have to pay $2 to roll. Is that a bad thing? I think it's a great thing.
Take that all day long.
Yeah.
We'll take that all day long. So that's really what we wanted to present to you today, this whole conversation. As you can see, it's not a real easy thing to argue on one side or the other, because there's a lot of moving parts, and that's why so many people make mistakes with it. So we hope that helped you. We've got another really cool Coach's Corner coming up next Thursday, 4 p.m. Eastern. So if you're new, it's great having you here, and we'll look for you then. Stu, thanks so much. We'll see you next Thursday.
Go Phils.
Go Phils.
See ya.